investment inclusive, such as the wealth products, through robot advisor, through all kinds of digital device innovations. So today my talk will mainly look at the advanced, the development in China as a benchmark to look at what we can learn from India and Brazil. So by recent work by my BIS colleague, you can left-hand panel, one of a Chinese big tech company called All Financial provide the financial service to a small business. If you left-hand side, you look at by my bank, the finance arm of our group, they provide more than 120 billion renminbi to more than 30,000 SMEs. Overall, in the right-hand panel, if you look at China as a total, in totals, so more than 3,600 billion renminbi provide this kind of small business lending or to the those small business and provide financial inclusions. So bottom line, we want to show what's new here. To summarize, we want to say, look, the experience from China, from India, and from Brazil is coming from the payment system. We start from digital payment innovation, then go through this kind of open financing platforms, finally provide the financial inclusions. So if you look at the business models, so a lot of big tech, private companies, such as e-commerce, social media, they run electronic platforms, use the network to provide, besides the financial service, or besides the e-commerce service, by products, they produce a lot of customer data. By past, accumulate, through payment system, accumulate a large stock of customer data. Through the data, payment systems, that start to provide a lot of financial service, so-called open financing ecosystems. So overall, based on our BIS recent work, we use 3 words to summarize the key business model. Through digital payment systems, we have data. Through data, we go through all the platforms, network, provide financial services, so-called activities, ecosystem, so-called DNA. That's the key business model for bottom-up approach in terms of digital finance, open banking, and provide financial service. So what's the performance? So based on my recent journal finance paper, I try to show some performance in terms of how financial innovation through payment system is going to provide financial service to small business. So number one, why small business are very important for the whole economy, and why they lack of financial service? Because number one, they don't have an alternative financing source. They have a low scale, opaque income source, no collateral, and sometimes no financial statements. Very hard to access credit through traditional financial institutions due to high credit risk. Secondly, most of them, small business coming from a developing economy, sometimes the credit market is very segmented. And finally, they live in rural, remote areas, in the mountains, in islands, the far away to financial service, so-called the lack of financial inclusions. So can digital innovation help? The answer is yes. Digital finance innovation provide financial service use coming from open banking, open finance benefits, so-called information advantage. Then they use big data, machine learning, algorithm for financial service. Secondly, through the platform, the network, online network, the distribution channel is very cheap. Sometimes they provide financial service to the borrower without physical collateral, and sometimes they don't have a credit reference, credit score. And finally, why digital innovation, digital finance might have a low credit risk? Because of platform externality, two-side market exclusions. So based on my research, recent published journal finance, we do find out the causalities from digital finance access and from growth. Literally after first month, you will see average sales for borrowers, small business borrower from digital finance platforms increase more than 3.5%. Average transaction growth for credit access is more than 3% after first month. If you look at a more comprehensive way in terms of academic studies, you realize sales growth after credit access jump more than 30%. And more importantly, so customers' capital, customer attention, customer rating also increase after you accept digital finance credit. Overall, what's new here? Through digital payment innovations, digital finance have a lot of new advantage compared to traditional banks. Number one, information advantage. If you look at the right-hand panels, you can see that we are not only observed from the lenders, the online SMEs, sales performance, service rating, personal characteristic, and more importantly, how to use credit. Okay, they not only have information advantage, platform distribution channels, more important, also money data platforms, and a very strong enforcement advantage. Based on recent discussion with Professor Ben Armstrong, we try to compare what's new here compared to traditional banking service, traditional lending models based on collateral. Once you have collateral, you go to a financial institution, borrows money. There's a trade-off between collateral values and information cost. However, if we have open bankings, open financing, digital innovation from payment systems, the cost of information almost come to zero. Acquire information, store information, verify some information. Okay, so information replace physical collateral, which is new here in terms of digital finance lendings. Due to time constraint, let me just give my final remarks. So future finance coming from open finance, digital financing will be very inclusive, scalable, or sustainable because they rely on digital innovations, to rely on more data, aggregate data, and behavior data, a ton of data. Then they use platform, distribution, customer DNA models, combine what we call data advantage, hard information through credit scores, software information from behavior data. They try to build up this ecosystem with the trust and reputations. And finally, we also need a global collaboration in terms of technology, infrastructures, and institutional infrastructures. And how traditional banks and financial institutions collaborate with digital finance. That's what comes to today's topic. I learned a lot from Governor Roy and Governor Dama's experience. The presentation talk about the Indian experience and Brazilian experience. Open financing is a key. Based on recent work by Augustine and about fintech, and more importantly, how to provide incentive and how to reduce information costs will help us to provide better financial inclusions. And the platform not only have online, also online offline integration. Finally, today my footnotes and provide some experience both from top-down approach and bottom-up approach, and provide future in terms of digital finance data governance structures. Okay, and finally, let me thank you and looking forward to comments and bon weekend. Thank you.
And thank you very much for finishing on such an exciting high note of the Finternet and global developments in what we're talking about here today. Okay, so now we move on to the Q&A session, and we've got plenty of questions that have come in, which I'm going to attempt.
Recording stopped.
Got plenty of questions that have come in that I'm going to attempt to field to various speakers in this part of the session, which is not being recorded. So speakers and questions can be as frank as they want. Can I start with a question directed to Kamya, which is whether all open financial ecosystems can be characterized as digital public infrastructures, or is there something that the public denotes that marks some as not digital public infrastructures?
So I think we characterize digital public infrastructure as open technology standards that are publicly available, and public doesn't always mean government. It can mean community, that allow for private innovation. And by design, open finance and open banking efforts, both open banking for payments and open finance for data sharing, are about open APIs for payments and data sharing, which by design, if implemented, make them digital public infrastructure. Of course, the quality of the implementation, the number of institutions, the scale makes it more or less effective digital public infrastructure. But yes, we would characterize nearly all open banking implementations, as powerful digital rails for your private financial ecosystem to thrive in serving customers and individuals in a society.
Okay, here's a second question, which I think maybe Dr. Rao Tavia could answer, which is it's about the sequencing of legislation. So I think everybody accepts that there's a need for data protection if you're engaging in data sharing of very sensitive data. Where do you envisage the sequencing of legislation there in terms of the implementation of open finance? Did Brazil or did India have comprehensive data protection legislation before it started down this path? Or did it adopt data protection legislation as part of the implementation? And if so, was this on a, if you want, a horizontal level or a vertical level? Perhaps Dr. Rao first could answer.
Thank you. I think thanks for that's a very interesting question. But if I may reflect on the Indian experience, actually the data sequencing, really the Protection Act came only passed in 2023, whereas your account aggregator framework was set up in 2016. So the sequencing wise, the account aggregator framework and the UPI frameworks rolled out much earlier to the data protection issue. But having said that, we have always been very mindful of the issues of sensitivity of the customer data and customer privacy concerns. So that's actually flows from the banking laws, where a lot of emphasis is kept on secrecy of the bank customer accounts, banking secrecy provision. So building on that, if you look at it, our account aggregator framework actually started off with a consent-based architecture. That has been a primary criteria in the account aggregator framework, that if you want data from a customer, you have to take a positive consent from him and then arrange to pull out the data from the respective financial information providers. So that was the starting point. Having said that, now that we have the Data Protection Act and the rules which are expected to be rolled out shortly, I think that will then define the way the data protections have to be given to the customers and what all levels of data privacy have to be enforced by these entities going forward. So I think that will be the way forward, but it was already envisaged in the initial account aggregator framework.
Tavia,
Okay.
where was Brazil in terms of data protection when it started down the road?
Okay, thank you, Bill. To understand the data protection, the open files, we can return to the 70s and 80s. There is a law since the 70s that all financial data is protected, cannot be shared outside of the financial sector. So it is the pillar of the protection. Some years before we initiate the open finance regulation here in Brazil, the Congress enacted a law for general protection data, and it is the second pillar. And the third pillar is in our open finance ecosystem, we belong only regulated, supervised institutions. We not allow non-regulated institutions. So all data must run inside of financial sector. And we return to the law in the 70s that protect all financial data in the financial sector.
Okay. The next question is one that's addressed to Dr. Rao, but I think several of our speakers might have something to say about this, which is about the role of big tech in the open finance ecosystem. I guess it's threat or opportunity here. We know that, for example, Google has a very large share of the payments, share of supply and payments in India. I think it's about 30%. Other regulators have asked us to question the CCF in terms of whether this is a good thing or they should be concerned about this. So what do our speakers think about the role of big tech entering open finance? Is threat or opportunity?
Shall I start, or
Yeah,
Ottavio,
please.
would you like to?
Go
Yeah.
ahead, Dr. Rao.
Yeah, thank you. I think this role of the big techs in finance is something which is engaging us as regulators, and it's going to play a big role going forward. And as you already mentioned, like when we look at the payment systems, the market share of the big techs like Google or maybe the Facebook could be very significant, and that can actually impact the entities which are the rest of the entities, because they may not be able to be as dominant as the big techs. So that is a big challenge. And when we look at our open finance ecosystem, what we think is that integrating the big techs into the system will offer promise of innovation and inclusion and efficiency. So we should look at considering them to enter, but with sufficient guardrails to be put in place. One idea is that perhaps they should come in as financial information providers, because they can provide a huge alternate data set to the ecosystem in terms of maybe the spending pattern, social media activity, or geolocation, which can actually help to get a better sense of the customer's credit history over and above whatever is available with the banking or the financial system. So coming in as financial providers perhaps may be a good way to start off, to look at their way, what you call, role in the ecosystem. And I think, of course, that doesn't mean that they are going to stop with that, because they have the data on the payment patterns, and that they can already build on it and perhaps create a huge database on the customers. So there, the concerns about customer privacy, data security will also come, because if they're gathering data through the spending patterns or something which is available on the app on which they are allowing the payments, I think that will create some data privacy and data security concern. I think that will have to be addressed through the legislation. And as I told you, we have already had the Data Protection and Data Privacy Act, which has come into play. And once those roles, perhaps the roles defined for these entities would get clearer in the times to come.
Thank you. Tavi, I'm unsighted of the presence of the big techs in Brazil. Have they arrived?
Okay. Bill, as I said before, when we designed the open finance here in Brazil, we decided that only can participate in the open finance regulated institutions. So if they want to participate in the open finance, they must be regulated by and obtain a license in the Central Bank of Brazil to participate. But we create the initiation payment provider. Né? It is a licensed institution, and some big techs, as a Google, obtain license to operate as an initiation payment provider. Né? So there is a limited scope to do the initiation of payments. And example, the Google obtained the license to be an initiation payment provider. So Google has been licensed by the central bank and has been regulated and supervised by the central bank for this proposal.
So I think the answer is that Google Pay is there, but it doesn't seem to achieve the scale that it has in India, or hasn't done so yet.
Yeah.
Okay.
Yes.
BIS, what is your perspective on this?
Okay, it's a very important research question, also on our, for our policy recommendations. 3 points. Number one, we got big tech provide a finance service. Immediately, we talk about finance stabilities. Second, big tech is a lot of issue in terms of privacy, and to Governor already mentions. Thirdly, competition, entry barriers. So in order to make big tech to deal with financial stabilities, competitions, and data privacies, so we try to combine them together with a traditional financial service under the radar of regulation, number one. Number two, in order to enhance all these kind of challenge for big tech. In China, we have JD, we have our financial, Alibaba, we have WeChat, we have social media, we have Tencent. So in order to regulate them better, we encourage innovation. Currently, for example, data privacy, we have technology so-called PET, privacy enhancing technology. PET is a lot of innovation through those big tech company to help the issue in terms of data privacy. So I think there's a lot of way to collaborate private, public, top down and bottom up approach to get benefit from big tech through the open financing technology innovations. On the other hand, to overcome the issue in terms of finance stabilities, because they provide a lot of finance service, credit online. Also, we talk about the privacy, also entry barrier in terms of competitions. So these are my 3 cents. Thank you.
Camilla, you talk mainly about the Brazilian and the Indian experience, but I know you know about a lot more jurisdictions than that. What's your take on this rather fundamental question? What's the role of the big techs here? Do we need to be careful, or are they powerful engines that we need to shake things up? Are they disruptors?
So I think, first of all, there's 2 kinds of tech we should all be thinking about, not just the big tech, but also the prevalence of small startup fintech, which actually can really power a lot of innovation, last mile innovation as well. So thinking about a framework that balances the needs and questions around both of those, I think is crucial. Second, even if you look around the world, or let's say if you look at the example of India, Google might have a large transaction share in the user experience, but they don't have a wallet in India, which means that the stored value account is never with Google, right? The stored value account is with Google linking to your existing bank accounts. And I think in the absence of a proactive framework that frames open banking for payments, you would start to see in other countries, Google creating its own wallets, right? Or other kinds of tech companies creating their own wallets, which are kind of outside of the banking system. And there will be inherent limitations to those wallets because they can't offer the value-added financial services of, let's say, a loan at the lowest possible cost. So you want people to be using the banking system. You want them to be using formal financial institutions, and they can leverage the big tech players in a sort of very constrained role, as Deputy Governor Otavio mentioned. As long as that role is very clearly constrained, let's say payment initiation, they could even play payment authorization if there's a standard authorization module that's offered, but they never see the flow of money because the flow of money is extremely sensitive, right? So I think in that context, it may be powerful to use them for what they're good at, which is to reach the customer and to build user-friendly experiences for the visually impaired, for people who need larger accessibility user experiences, which banks historically have not been the best at doing, but keep what the banks are good at doing within the banking sector. That's kind of my view on this.
Okay, that's very helpful, and people seem to be reasonably content with what's happening. That maybe there are risks, but we have sufficient controls, guardrails, regulation, then we can handle that. Okay, next question is specifically for Otavio, which is that since Brazil is oft quoted a success in open banking and open finance, the question is, how much open banking has been successful in increasing financial inclusion in Brazil? I think the implication of the question is that, yeah, a lot of people are using open banking, but these were the people who already had bank accounts. They were paying digitally. So to what extent has open banking in Brazil furthered the objective, if that was an objective, of financial inclusion?
Okay, thank you, Bill. I can say that the most important drive for financial inclusion in Brazil has been the PIX, the instant payment scheme that exists in Brazil. When the customer enter using PIX, they go deeper in the financial sector using open finance. But the most important drive for financial inclusion is the PIX, not the open finance. The open finance can improve the involvement of the customers with financial system, obtain more products, more services, more cheap, more customized product for them.
Okay, here's a question I think that all the panelists should be able to have a view on. It's quite specific, but I think I can see there's perhaps a more general point here, which is There's no doubt that open finance can revolutionize a country's financial sector by promoting financial inclusion amongst other objectives. What should Ghana put in place for it? What should Ghana put in place there? And I think maybe for the question is perhaps a bit more general in terms of emerging economies. What are the real benefits for open finance for emerging economies? Let's start with I don't know. Let's start with Dr. Rao.
I think interesting question. Perhaps Ghana could learn from the Indian experience, and I think the three building blocks which we focused on is because we had the very challenge of reaching a huge amount of underserved or hitherto excluded segments in the society. So I think the three elements would be in terms of the identity, that is getting the person an access to a bank account, having an identity established for the person so that there is a bank account onto which the transactions can happen, a payment infrastructure, which again, the digital payment infrastructure, the UPI framework was kind of a stack through which the payments could be done. And finally, of course, in terms of what do you call the lending platforms, which we are planning to roll out. I think that is the third or the missing segment hitherto, but that once that develops, the banks will be able to seamlessly expand the reach of financial services to provide all kinds of products for the customer. So identifying the customer, opening a basic banking account, enabling him to access the bank or enable transactions through the mobile systems would be one building block. Having a payment system which enables that to happen could be the second. And a credit interface which will enable the banks to assess the credit worthiness of the borrower through the account aggregator system, through other databases which could be pulling out the data regarding the credit worthiness of the person, and enabling a payment into the customer's account through a UPI kind of a link. This can enable persons who are in the margins or who are located in remote areas to access credit. So I think that learning from India could be actually transported to a great extent or ported to a great extent to many of the emerging markets where this could be, I think, quite helpful.
Kamia, well, I guess you might share that view.
Yeah, I mean, if you're talking about Ghana specifically, they already have GIPS as a payment system. They have a Ghana Universal QR standard. So on open banking for payments, they're definitely making good progress. I suppose, to echo what Dr. Rao had said, inclusion, when you're thinking about financial inclusion, I think creating credentials for KYC are often underrated, because without that, you end up trying to pull in people without accounts into an open banking ecosystem, and therefore they have to compete based on wallet accounts, which doesn't work in the long run. So certainly the eKYC or credentials for identity are critical. But I think in general, in emerging economies, the impetus is not just about competition or market competition. The impetus is about growth of the formal financial sector and the credit portfolio. Often many emerging economies have low credit to GDP ratios because most people are seeking informal credit. And so I would go through the series of blocks across digital public infrastructure in all of these areas, whether it's identity, eKYC, but also open banking, open finance. Make sure that your technical specifications are modern and interoperable, up to date. They look like the internet in that sense. Your specifications are flexible. And finally, look at data sharing as a very critical component, because top-down pushes of credit, supply side interventions like interest subvention or credit guarantees, they only go so far in driving access to credit. The root cause of people going through informal loan sharks is because they can't get credit from reputable institutions at the best prices, and therefore they face usurious interest rates. And the root cause is the lack of data and the flows of data. So thinking about both synchronous real-time data sharing mechanisms and maybe asynchronous generation of verifiable credentials of data are key building blocks for emerging economies around the world.
Okay, let's go to Brazil next.
Okay. As I said in my initial remarks, the main target for all innovation agenda imposed by the Central Bank of Brazil was to improve competition. So it is very aligned with Kaiman said. Of course, the open finance, one of the main targets is to improve competition in the financial sector. We adapt our regulatory framework to open the door for fintechs entering the regulatory perimeter, and the open finance is the way to improve them in the competition arena. So, but I can say that open finance can improve efficiency in many dimensions, both for consumers and for institutions, even for incumbent institutions. So in the credit market, in the payment market, in the KYC process, in the openness of accounts. So there are many dimensions that open finance can help to improve the efficiency.
Thank you. BIS.
Okay, so my 2 points as following. Number one, in terms of open banking, we think about Kenya. We have people lack of a bank account. We have M-Pesa from mobile banking. We come to big tech from China, from India, and from Brazil. We have a innovation into payment system. From payment system, access information, sharing the data, some payment to the lendings, to consumer financing, also into this kind of inclusive investment, provide saving products. Overall, there are another benefit besides the efficiency, competition for risk adjustment. For example, in terms of consumer financings, people usually have a lot of behavior bias, overspending, forgetting to pay the bill. Because access open financings, you have a more real-time adjustment, reminding, accessible to warn people credit risk, all kinds of potential risk, which is a lot of ongoing literature, use Indian data, Brazil data, Chinese data, try to prevent so-called credit risk, also this kind of behavior bias. So I think, the benefit is very, very severe, efficiency plus risk preventions. Thank you.
Thank you. We're running a little bit over time, but we started late. But nonetheless, we're going to have to draw this to a close in a second. But one final question for all of you. You have in the audience here today, the participants from regulators from all over the world. We were joking before we started that there are so many financial regulators here at this meeting. We're slightly worried about who is minding the shop at the moment. But what advice could each of you give? One piece of advice, one tip to regulators who are contemplating or in the process of implementing open finance. Something you've learned or something you've picked up that would actually some practical help to them that they should definitely do. Let's take it in the order that we that the speakers addressed us today. So let's start with Kamya.
This is a tough one because regulators have a very difficult job. But I would say that the key thing that regulators should think of is to not be afraid of framing technology specifications. I think sometimes regulators worry that this isn't the expertise area of a typical regulator. And so therefore, how can we frame these specifications? Is it even important for us to do so? I would say that technology specifications the best ones are very light and very small, and they're not the same as having expertise over whole technology systems. But framing specifications well can have a huge ripple effect on the way your ecosystem shapes up. And so therefore, I think leaning in to ask some questions to understand what does a good technical specification look like and is not rocket science actually, and can be very powerful and empowering for a regulator to actually play that role in taking that shape. The second small thing to say is orchestration of the market. You can't just put out specifications and wait for adoption. I think regulators have a strong role to play in thinking through, especially with larger banks, how can we nudge them towards doing the right thing for customers and individuals on the end? Because individuals don't have a voice with large banks. only regulators do. So that's where I would pause.
Thank you. Very good point at the end. Bank of India, Reserve Bank of India, what's your tip?
I think I mentioned in the beginning itself that we should be willing to, what do you call, accept innovation, but we need to be mindful of the risks. I think that's a key point which, as a regulator, I would focus on. I should not discard an innovation because it can, see, any innovation can threaten the stability or impact on the, create a bigger risk in the system. So willingness to innovate should be, we should be open-minded on that, but we should be mindful of the risk. In fact, one good example which I could cite from our experience in India here was when we had this COVID lockdown, we had the growth of digital lending apps, which manifested itself. And then instead of rather clamping down on them or banning them, we did study the mechanisms which they had, found out what are the weak points in the whole processes. And we had a group to study the whole issue and come out with a set of recommendations. So we ensured that the digital lending apps come out with the, what you call, operate through the regulated entities. That is one thing. Then put the onus on the regulated entities to ensure a fair deal to the customer, because customer protection and fair deal to the customer, I think, are basic things which we as regulators should focus on. So I think that way of approaching the issue in terms of accepting innovations, but also trying to simultaneously address the risk would be the way forward. So we can look at any kind of innovation coming into the system with an open mind.
Thank you. And the Bank of Brazil, your one tip for the regulators today?
Okay. Well, based on the Brazilian experience, my key advice is full engagement from the supervisor in the whole process. The regulation framework is not enough. We must follow all process, and as Kamian said, the specification is very important. In the case of Brazil, we have a private governance established by the Central Bank of Brazil, but they are private, and we are full engagement in all process and looking for the specification, looking for the decisions, and make orientation for them if we observe that something is not align with our targets. So engagement, supervisor engagement is my key advice.
Thank you very much. And the Bank for International Settlements, what is your piece of advice for regulators?
Okay, I think very important in terms of regulators, in terms of the risk. We cannot emphasize more of a risk because of incentive to verify information. So far, we put all the information together. We deal with lack of information. We deal with information asymmetry. But very important to have incentive to verify, underline those information is correct, which is something is a risk we're going to face. Secondly, in data, in terms of sharing, in terms of leakage, there was a lot of leakage, a lot of sub-attack. Recent sub-attack is kind of leakage risk increasing dramatically. But the second risk I'm going to emphasize. Number one, verifies information. Okay, potential people are always a free riders in terms of to verify information. Secondly, in terms of sub-attack, in terms of data leakage. Thank you.
Well, thank you, and thank you to all of our distinguished speakers today. And thank you for your presentations and for answering sometimes a little awkward some of the questions, and you weren't expecting them either. So thank you for being frank as well as comprehensive in your presentations.
Thank you very much.
Thank you.
Thank you.
It now remains me to pass the microphone myself over to Tao Zhang, who will be making closing remarks for this session. So thank you again very much to our speakers on behalf of our participants.
Recording in progress. Thank you. Can you see me now? Hello?
I can't see you, but I can hear you. I can see you now.
Oh, okay, good. Okay, all right.
I can see your
Okay,
screen, but not you.
good. Can you anyone see me, or I don't know how to handle it.
Yep, that's done it. That did it.
Okay,
That's
good.
it. That's it.
Okay, got it. All right. Okay, yes, it's done. It's all right. Okay, so thank you, Bill, and good morning, good afternoon, and good evening to the colleagues around the world. It is my great pleasure to say a few words as closing remarks for this very important and also and very timely conference. Let me, of course, first join my BIS colleagues in thanking both the Cambridge Center for Alternative Finance and the Center for Digital Public Infrastructure for co-hosting this event. And as you have heard from various speakers throughout the sessions, in an increasingly digital world, the issues of the open finance, particularly the data, are of paramount importance, both for individuals and for SMEs and also business. And against this backdrop, there is an increased awareness that the open finance ecosystem can benefit financial system participants and society in general, in terms of the creating an environment in which the competitive advantages of different players can be used to provide people with better financial services. So, of course, the BIS, we work with our member central banks and other stakeholders, and including, the RBI and the Central Bank of Brazil, which both governors have shared their experiences. We also, try explore some of these new dimensions through our innovation activities. One of the project we are soon will launch, which is dealing with our cross-border open finance infrastructures. This is a joint project with many central banks, to my knowledge. RBI and Central Bank of Brazil also joined the project. I'm not, this is, since this is the closing remarks, I'm not going to get into the details to the project. Instead, let me have a little bit reflections on what I learned or what is my main takeaway out of the today's discussions. So firstly, in my view, there have been significant barriers to financial inclusions in most economies, but particularly in emerging markets. They emanate from a societal attitude, legal framework, and higher transaction cost. As the technology progressed, particularly in the last decade and a half, carefully designed DPIs, including open finance architectures, have emerged, which provide a potential way forward for countries leapfrog traditional stages of development in this area. That's one takeaway. Secondary, in terms of the financial development, as my BIS colleague mentioned today, a collateral gap, because the large percentage of the world populations, including the SME, small businesses, even if they do have bank accounts, but normally they cannot borrow funds because of the inadequate tangible collaterals. So that's the collateral gap. So data and activities collected by digital platforms in this regard, can help to overcome these difficulties by bridging the gap and creating information as a new capital. Thirdly, we have heard how open finance can support financial stability. So the stability is one of the important dimensions for central banks. An open and efficient financial system can foster robust competitions, encourage new entrants, and keep existing service providers nimble. So these are very good development or encouraging development that will promote continuous innovations within this financial industries and hopefully lower the cost for customers. Finally, I want to mention that while open finance offers us, quite a wide range of the benefits, it also potentially poses significant risk and concerns. I think both governors mentioned it, particularly around the privacies and data securities, and of course as we all discussed, the robust governance will remain essential. So that's pretty much the major takeaway I wanted to share at this moment. So, but before closing, let me take this opportunity to once again thank the CCAF and the CDBI for co-hosting this conference with us. And in particular, I would like to thank Nick Clark for giving such enlightening opening remarks, and Bill Robert for his excellent moderations of the panel discussions at the end, as well as, of course, Kamia Chandler for her thoughts on the global best practice in open finance technology architectures. And of course, my appreciations goes to all the speakers, Deputy Governors Rao and Deputy Governor Damaso for your insightful views and sharing of the lessons learned from your own countries. And of course, last, my thanks go to all the participants for tonight's conference. With that, let me close the conference. I wish you a pleasant weekend. And thank you. See you next time.
Thank you.
Thank you.
Thank you.